Bismillahirrahmanirrahim. Subject is principle of auditing and lecture is on audit risk assessment. This is second lecture on audit risk assessment. Topic to be covered in today's lecture are preliminary assessment of control risk, process of assessing control risk, the audit risk model, audit risk component, relationship between among audit risk component, non-quantitative risk model. Preliminary assessment of the control risk. Auditor will identify the risk at two levels: at financial statement or financial report level, or at assertion level, means transaction level, account balances level, and disclosure level. There may be a risk that any specific transactions have been incurred but it have a risk of misstatement. There may be any specific account balance which have the chances that it will have any misstatement, or any disclosure given by the company, there is a chances of risk prevail in their disclosure are materially misstated, and their aggregate total misstatement reflect in financial report. So the first step of the auditor to assess a risk, that auditor shall first identify and assess the risk of material misstatement at financial report level and assertion level for classes of transaction, account balances, and disclosure. Second step for assessing the risk is to obtain reasonable understanding. Reasonable understanding. Why reasonable understanding? Because the auditor will further decide it to develop a proper audit strategy and then design a detailed audit programs. Without understanding of the control of the company, our internal control system or control environment, the auditor will be unable to plan the audit and develop appropriate audit strategy or design a detailed audit program. Process of assessing of control. This is basically based on professional judgment to assess the control environment. Any experienced person, when entered in any organization, he is easily in a position to examine the effectiveness and efficiency of internal control environment. Even he can observe that how much people comply with the written document or not, because control environment of multinational and control environment of the local manufacturing or local company will be quite different from one another. So professional judgment help the auditor to assess the control environment of the company. Then what are the design effectiveness of internal of control procedure? Are the control procedure are effective to prevent any fraud, to prevent any misstatement, to prevent any any embezzlement of the fund or misuse of any assets? That is the second steps to assess the internal control system. Then the auditor should see the consistency of the internal control. What does it mean by consistency? Whether the auditor would examine that either the control are effectively applied throughout the year, or it is just fully comply on any one specific day, and then the employee forget about the internal control system. just like in public sector, if the CM, for example, if seeing chief minister is going to visit any hospital, we will see that all patients are really clean, all the bed sheets and the foam and the beds are and the total wards appear in the TV screen very clean and neat. But for the whole year, these control environment that we are watching on a TV screen, specifically in response to this visit of the CM to that specific hospital, we never expect that that type of procedure are being followed in normal circumstances. So the auditor should see in a similar way that these internal controls are effectively applied throughout the period or not. Audit risk model. Audit risk model. Audit risk is a risk. What is audit risk? It is a risk that auditor give inappropriate audit opinion when the financial statement are materially misstated. It means that if the financial statement do not present the true and fair view of the company, but in that case the auditor gave a true and fair view of the financial statement, that is basically there is a chances. So in order to reduce that chances that the auditor may give inappropriate opinion, in the case when financial statements are materially misstated by the management, it is called audit risk. So the auditor always try to reduce that risk because it questions its professional integrity, it questions its professional competency, it questions its professional due diligence. Even the auditor may be sued for professional negligence if he gave an inappropriate opinion while the financial statements are materially misstated. So the auditor will always try to reduce that audit risk. So in setting the desired audit risk that is tolerable, auditors seek the appropriate balance between two things. Cost of incorrect audit opinion, that is one cost. It is a huge cost. Is I said earlier that the auditor may be sued for the negligence. It questions the professional competence of the auditor and the cost of performing additional procedures. So he should make a balance between the two. If he is in a position to afford the cost of giving incorrect audit opinion, and then the cost of applying additional procedure, he should go to give incorrect audit opinion. But it will, but the auditor will pay a huge amount, huge cost for giving incorrect audit opinion. In a history, in case of Enron, Arthur Anderson was a big audit firms which become blacklisted because of giving inappropriate audit opinion. So performing additional audit procedures will be necessary to reduce the audit risk. Audit risk component one is inherent risk. No matter how much the human being are competent or vigilant, but again the system developed by human being have some inherent limitation. And same is the case for internal control system that is developed by the competent and professional employee. So the possibility of material misstatement could occur either individually or when aggregate with other misstatement. Means individually means at account balance level, at any transaction level, or disclosure level. The misstatement may have been possible, or these are not material individually, when aggregate it become material. So in this misstatement, assuming that no related control is possible for this material misstatement, it is inherently possible in the system that there might be material misstatement in the financial reporting or or any financial report level or at the assertion level. Second is the audit risk, inherent risk, exists independently of the audit of financial statement. So audit process cannot reduce this inherent risk. It works independently, and thus auditor cannot change the actual level of inherent risk. Inherent risk, like in case of depreciation, if asset have a useful life of 10 years, this 10 year is basically totally managerial judgment. It may be life of 20 years, it may have a life of 15 years. So it is inherent in the case of accounting. Similarly, depletion of any mining assets of the company, that how long it would be depleted fully depleted, but it is again a judgment. So there is some inherent limitation and estimation as well as in judgment in the accounting system. As defined by the auditing standards, inherent risk is confined to the risk of material misstatement. So the possibility that there would be some material misstatement in the financial report or at any account balance transaction or in any disclosure. Audit component. Control risk. What is control risk? It is a risk that material misstatement could occur at assertion level, means individually, which we call at transaction level, at account balance level, and at disclosure level. It is material individually, or it may not be material individually, but when we combine it, it becomes material. We will discuss materiality principle just after this lecture. But these misstatement is possible that it could be protected and prevented by internal control, but these are not be prevented, detected, or corrected on timely basis by the entity's internal control structure. So it is basically that internal control structure can prevent this material misstatement. It is not inherent, it can be prevented. But what happened, that internal control structure was not applied, or employees was unable to comply with the internal control structure, or there was no environment to fully follow the company policies about the internal control. These are the main reasons that the misstatement may occur. So control risk is a function of the effectiveness of the internal control structure. If the internal control structure is effective, it would reduce the control risk. So is good control reduce the risk of reduce the control risk. So effectiveness of internal control is may be applied by the management or the entities or those who charge with governance in order to reduce the control risk. Audit risk component. That is the third component of the audit risk, which is called detection risk. That is basically that the auditor apply its substantive procedures or audit procedures to reduce the risk. It is this is the risk that can be that an auditor substantive procedure will not detect any material statement. It is a possibility. It is the risk that the audit substantive procedure or auditor was unable to detect material misstatement that exist in assertion individually or when aggregated with other misstatement. So the audit procedure applied by the auditor were not of the level to detect the misstatement in the financial reports. So the auditor will reduce that risk by any mean in order to reduce the total risk. It is a function of effectiveness. Effectiveness of what? Of substantive procedure. If substantive procedures are strong, that it would reduce that detection risk. If the auditor applied additional substantive procedure, it will reduce the detection risk. It will further reduce the detection risk. So it is the function of effectiveness of substantive procedure and their application by an auditor, and thus is fundamental to the audit work undertaken by the audit. The first two risks are not in the hand of the auditor, but detection risk is at the hand of the auditor. The level of detection risk is controllable by auditor through what he will do. He will do that by applying appropriate planning can reduce the detection risk. Direction to the audit team can reduce the risk. Proper supervisions and review can reduce the detection risk. Variation in nature, timing, and extent of audit procedure, that the auditor always change its audit procedures will lead to reduce the detection risk. Effective performance of audit procedures by the audit team and then evaluate its results will reduce the detection risk. Relationship among detection risk are: auditor objective is to achieve acceptable low level of audit risk as much as possible. So recognizing the cost of performing the audit procedures, and there is an inverse relationship between assessed level of inherent and control risk and level of detection risk the auditor can accept. The auditor, although unable to control inherent risk, as we discussed earlier, it is not in the hand of the auditor that he can control inherent risk. Even control risk is in the hand of the management to apply effective internal control environment. Can assess, but auditor only, what can auditor do? He can only assess these risks. And then after assessing these two risks, he will design his substantive procedures to produce acceptable level of detection risk, thus reducing the audit risk to acceptable level. Further, it will be very clear in the coming slides. Relationship among the risk component. Audit risk model provides a framework for the auditor to apply responding to these assessed risks through their choice of audit procedures. When he is assessing these risks, then he will be able to select his audit procedure to be applied in order to conduct the audit. The audited model expresses the relationship between the component of the audit risk as follows. Audit risk is equal to inherent risk and control risk multiplied by detection risk. If auditor assesses that inherent risk is quite high, control risk is quite high, he would reduce his detection risk to a minimum level in order to reduce the total audit risk to acceptable level. If he says that inherent risk is quite low in the organization, there are effective control implemented in the client, so control risk is very much high, then there is no need to decrease this detection risk. The auditor may apply normal substantive procedures. So there is inverse relationship between these two. These two are not in a control of the auditor. He will just assess these two risks, and then he will apply his substantive procedures which will reduce detection risk while seeing these two risks, while assessing these two risks. There is inverse relationship. If it is high, he would try to reduce detection risk. If these are low, there is no need to be worried about the detection risk. Auditor may use non-quantifiable expression for the risks, such as using their personal judgment. This is consistent with the quantifiable audit risk model, and that acceptable level of detection risk are inversely related to the assessment of inherent and control risk, as discussed in earlier slides. If the assessment of control risk and inherent risk, the auditor assesses that these are both very high, what he will do, then acceptable level of detection risk will generally be very low in order to achieve the audit risk to acceptable level. And the risk that the auditor substantive procedure will not detect material misstatement will need to be low. So he will not tolerate a high risk in his detection. He will apply additional substantive procedures, which means more substantive testing would the auditor be applied to reach to the opinion. But what he will do, he will not use sampling, vouching. He will verify if a lot of voucher. He will physically check the assets. He check the ownership of the assets. So all these substantive procedures will be applied in a high extent. Conversely, if the auditor assessment of the control risk control and inherent risk both are low, then the acceptable level of the detection risk can be high. The auditor's substantive procedure can be reduced. He may just obtain a certificate of the ownership while not physically checking the asset of the client. This is all about today's lecture. Thank you.